Welcome to Stock Talk with Nico Kritikos. Today we're going to be doing some stock analysis for Paycom, ticker PAYC. So first thing we're going to take a look at here is the stock chart. As you can see, it's been roughly flat over the last year, down about 7%. And the market cap on this company is currently $17.9 billion. What Paycom does is they are a cloud-based software as a service company that helps companies manage their employees better. I guess you could say they help with multiple different things. If we look at one of their reports here, we're going to see they help with companies doing talent acquisition, time and labor management, payroll, talent management, and a bunch of other things. So that's what this company does. In the last couple of years, they've done a pretty great job growing their numbers. If we look at the revenue for this company, we're going to see that on average, they're growing at about 26 to 30% or so. Definitely a pretty strong growing company there. And same thing for net income. It's pretty strong. We're looking at about 33% average growth in the last 5 years. So those two things are good. If we go to the PE ratio for this company, it is higher than a lot of others, right? We're looking at a forward PE of 46 here. If we go to Yahoo Finance, we're going to see the forward PE ratio is 39, according to their numbers. Either way, if we're talking around a 40 or 50 PE ratio, that is pretty rich, right? So this company kind of deserves it, though, you could say, because their growth has been upwards of 30%, and that makes sense. However, if you look at the upcoming year and the following year, we're looking at growth rates closer to 20% or 23%. So that's why I think the valuation on this company has come down a little bit, so you have to keep that in mind. But if we are looking at a history of where this company normally trades, we're going to be looking at PE ratios ranging from about a 50 all the way up to 187. So right now we're sitting at a 60. That is on the lower side. So this may not be a super rich valuation for a company like this if they can put up those growth numbers. But their growth has come down considerably, so make sure you keep that in mind. Then we're going to take a look at their innovation. I would definitely consider this an innovative company. They are using the cloud as part of their software, and they're trying to combine all those different services of payroll and acquiring new employees, all these different services into one software. And so I would consider that innovative. As far as a moat goes, potentially, did I read they have 6 million companies, I believe, that are their clients. So I don't know about the moat side of things, but as far as innovation goes, I would definitely consider this to be an innovative company. If we're looking at the industry, we're looking at payroll software companies growing at about 9% per year. So this company is doing, double or triple that, which is better than most of their competitors. Then we're going to take a look at their return on invested capital. And what we are going to see here is these numbers are also very strong. We're looking at 20% all the way up to 37%. So those are phenomenal. Those are much better than the 7% minimum that I'm looking for here. Then we're going to get to their balance sheet. And we're looking at if their equity has been growing, not counting the goodwill in the balance sheet. And what we're going to see is that the goodwill is not too significant in their balance sheet, so we don't need to worry about that. It's only about $100 million, and their equity has gone from 500 million to 1.1 billion, so nearly a double or more than a double in 3 years. That's great. So that's going to get a check. Then we're going to take a look at this kind of goes back to the valuation. Is it over 15% of the market cap? No, unfortunately not. Remember, this is nearly an $18 billion company. So a $1 billion equity stake is not really going to cut that. Share count decrease. Unfortunately not. If we're looking at the shares, there is a small increase in the last couple of years. It's inching up just by like 1% per year. So really not that bad. That's nothing to be worried about. That's totally fine. Is the balance sheet, do you see 2x the assets and liabilities? No, you don't. So that's going to get a no. Not the end of the world. Once again, that's not the end of the world. Not every company can hit those type of ratios. That's fine. Profit margin over 10%. Well, yes, we're looking at margins of 20%, 19, 17, all the way up to 24. So those are phenomenal. That will get a check as well. cash and receivables. Then we're going to go back to the balance sheet. We're going to see cash and receivables are about $428 million. Meanwhile, this company was putting up net income, I believe, around 100 to 200 million. Yeah, probably closer to $200 million, and they're approaching 300 million. So they got a good amount in cash and receivables. No dividend, that's okay, and it is over 20 years old. I believe it was founded in 1998. Okay, so all in all, not too bad, right? We're looking at a score of 10 out of 14. So that's pretty good. So I can see someone who says they are interested in investing in this. I get that. I personally think it's probably about fairly valued, and that's why I'm not too interested in investing in a company like this. If they're doing 20% growth rates, you know, I would say in order for this to be a deal, I would say you would want to be seeing a forward PE ratio of closer to like a 25, right? Maybe a 25 or a 30. Yeah, something like that. So that's where I'm at with this company. I mean, it sounds like a great software, though. It sounds like if their numbers are growing that fast, that's phenomenal. So that's what I have to say about Paycom. Thank you for watching, and I will catch you guys in the next video.